Welcome everyone, and thank you for joining us for a really exciting discussion on the future of luxury investments. My name is Laure Guilbault and I'm Paris correspondent at Vogue Business. Before we begin, don't forget to head over to the event community where you can meet other attendees and Vogue Business editors, including myself, so feel free to say hello. What do recent and upcoming M&A deals and investment tell us about the future of luxury investments? This session will explore the state of the industry by discussing notable deals and investments. And now let's introduce our panelists. Stefano Martinetto is Chief Executive and co-founder of Tomorrow Group, a development platform for fashion brands. Today, the group is investor in brands including Coperni, Martine Rose, Charles Jeffrey Loverboy, and the omnichannel retailer Machine A. Marco De Benedetti is Carlyle Managing Director and co-head of European Buyout Group, with a particular focus on branded consumer goods. Marco currently also serves on the boards of directors of a flurry of groups, including Moncler. Sweta Ramachandran is an investment manager at independent asset management group GAM Investments. She has been responsible for managing the luxury equity strategy since 2019. And Erwan Rambourg is managing director and global head of consumer and retail equity research at HSBC. Erwan has been covering the luxury goods sector for 15 years. Prior to that, he was marketing manager in the luxury industry, notably for LVMH and Richemont. He recently published a book, Future Lux, What's Ahead for the Business of Luxury. Welcome, everyone. Thanks for being with us.
Thanks for having us.
Hi, great to be here.
Thank you. Let's get started. Marco, what trends do you see in M&A post-COVID?
Well, hello, everybody. And again, thanks you for having me. It's always hard to predict trends, but I think that there are a few clear that in my mind will happen. I do believe that the size matters, and I think size will matter forward. So I do expect that we will continue to see further concentration. Larger groups have a number of advantages versus the smaller brands, and those become even more evident today with some of the rapid changes that are occurring throughout the industry. So the first trend, in my view, will be concentration, further concentration for the benefit of size. Mm-hmm. The other is brands and the luxury sector they're pretty traditional in the way the business was carried about. And what the recent pandemic, in my view, has had as an impact is that it's accelerated a number of trends that were already pre-existing. I don't think there is anything new, but everything is happening faster. So the time horizon on a number of projects or a number of strategies is much shorter, and you have to do it faster. I think there will be a race to human capital, the need to bring in talent and expertise that were not there before, and they're not in the DNA of a traditional fashion brand, which is really about the product. And as I keep saying, if you have a great product, maybe you can build $100 million business. But if you want to build $1 billion business, the product is not enough. You need a number of other things. And I do believe that will fuel, M&A transformation, consolidation, because the need to get access to those competencies is much more relevant today.
That's very interesting. Erwan, I'm curious. Marco just said that size matters. Why do conglomerates have an edge when it comes to the post-COVID environment?
Well, first of all, thanks a lot for having me, and I'm delighted to meet again some of the panelists here. What I would say about the strength of conglomerates is we've lived a period of the past 15 to 18 months of doubt, right? And in periods of doubt, I think consumers have a tendency of buying less, but buying better. And it just so happens that also we've seen a tremendous amount of wealth creation, notably here in the US, which has triggered first-time purchasers. And if you're buying, you know, a luxury product for the first time, you want to get it right. And so I think that that has actually supported the leaders as well. We've seen phenomenal market share gains from the likes of Cartier and jewelry, Rolex and watches, Vuitton and handbags. So you have this tendency to go to the most established brands. I think one of the reasons conglomerates have an edge beyond, you know, the scale of some of the brands that they actually own is this idea that you're changing the pace in terms of negotiating power as well. You know, imagine LVMH, just to take the elephant in the room, and how their negotiating power has evolved relative to shopping malls or department stores or, you know, other operators across the globe. Clearly, they have a much better hand to play now because they attract, you know, a lot of the traffic and a lot of the appetite. I think the other element that helps conglomerates, and it goes to the point of, Marco, that this industry is changing pretty swiftly, and you need talent. And I think if you are one of the outperforming conglomerates, you have the means to attract, to retain, to develop talent. And you know, HR folks always start with people, and you know, I would end with people. But I think clearly, if you're looking to evolve your business model, if you're looking to go beyond the current crisis and continue to gain share and to be at the top of your game, you know, scale will matter as well, because you'll be offering people a career path. And so, yeah, I think the bigger conglomerates are in a good space to be able to attract that top talent.
Okay, thank you. Stefano, actually, in a world of mega brands, you invest in smaller brands. So it means that you're confident that there remains space for smaller brands. Can you share your point of view?
Yeah, thank you again for inviting me. And my position is slightly contrarian to the main and extremely logic positions. We come to the market as an operator, so not initially as an investor. So we learned to work with small brands and allow them to make their first baby steps into their initial 10, 15, $20 million of revenues. So we learned the job the hard way. We have an investment thesis which is slightly different. So we expect the Gen Z consumer that everybody is welcoming as the 50% of, you know, consumption in the next 5 years, to have a slightly different approach, to be less attracted by large legacy brands than the previous generations, and less influenceable by traditional marketing strategies. Because of the dominance of these consumer groups, our expectation is that the consumer group will look into brands with a more personal, you know, personal approach, and will identify funders, creative entrepreneurs and funders who also represent a community and a value system in which this consumer can reflect their own needs and desires. Because of this assumption, we focus our attention to independent creative funders who have reasonably small businesses, but they have a unique DNA, a unique point of view, and a niche, which can be a global niche. So we go other focus on these niches, and we support the idea that these niches can be somehow owned by individual funders, and hence, in combination, becoming a sizable market.
Right. And how big can tomorrow get?
Well, that depends on, we have 3 businesses. We invest into independent brands. We are a digital and physical B2B operator, and we are recently enhanced the capabilities to run the D2C, both on multi-brands and mono brands. We believe that in a very large market like like the fashion industry, there is a relatively small market of independent designers, mostly B2B, and proportionally 20% B2B rather than the opposite. It's a portion of 20 to 30 billions. We believe there's a chance for one operator, if done well at scale, to be a dominant figure in that niche of the market. So in a way, instead of looking at a huge market of the luxury, we are looking at a very specific niche of that market and trying to have the largest play of it, essentially. So you could, the question, it could be raising to $500 million to $1 billion in sales. In that regards, it's not unthinkable.
Sweta, we've just seen that there are multiple ways to invest in luxury. You invest in public companies. What's specific about investing in public companies?
Hi, Laure. Thank you again for having me on this panel. So yes, I invest in publicly listed equities, which in this sector is a particularly unique beast, I would say, because the influence of the founding families or the controlling families is quite outsized versus other sectors in the market for luxury particularly. And that means as a minority investor, being attuned to and aligned with management strategy is much more important than other areas of the market where you do have the recourse, for instance, of being able to vote against proposals or even kick out management. That's not really an option for minority shareholders in many of the companies in the luxury sector. Also, top-line growth really is the key driver of value creation for the luxury industry, whether that's organic or through M&A. And so again, being aligned with a company's discipline around capital allocation is probably much more important in the luxury sector as well than in many other sectors of the market.
Can you share some names of companies you've invested in?
Oh, well, I mean, the usual suspects would be obviously the publicly listed companies within Europe. I mean, at one point or another, I've invested in pretty much all of them. LVMH, Hermès, Kering, you can name them.
I see. Erwan, a question for you. It seems that there has never been so much cash available on the market, yet there's a scarcity of targets. What's your view on this?
Yeah, I think there is a lot of cash. I think money is pretty cheap. I think the difficulty in luxury is that it's a seller's market, right? And I keep on getting the question, hey, why doesn't LVMH buy Chanel? And it's an interesting question, but the real question is Chanel a seller? And the answer is no. So I think deals will only happen when sellers will be willing to sell. And to be fair, over the past 12, 18 months, you've had a lot of deals happening simply because I think a lot of sellers were thinking this might be a good window. It might be a good window because valuations have been pretty high. It might be a good window because following the COVID-related difficulties, maybe some families have been thinking, will my name be in the bright lights in 20 years? It's not a question of going bust. I think even the underperforming luxury brands are pretty profitable. It's more, how do you think about developing the asset for the next generation? And some have come to the conclusion that the better way is basically to develop a deal with a bigger partner to ensure that indeed your brand, your name will be in the bright lights in 20 years still. But again, we have to come back to the reality that it's a seller's market. And interestingly, when LVMH bought Tiffany, they told everyone this is the last deal in a while. And over the summer, they did another 6 or 7 or 8 deals, simply because they had the opportunity, simply because sellers came about, and they thought, yeah, let's be pragmatic, let's look at them, and they decided to go for it. But again, you don't decide on the timing. Sellers decide on the timing on whether they're open-minded or not. So that's the very particular aspect of this business. Sellers decide, buyers don't.
It's interesting. You said Chanel is not for sale, nor is Richemont actually. What is keeping the Richemont Kering deal from happening?
So I think Richemont and Kering together in the same portfolio makes a lot of sense on paper. All the more so as LVMH used to be the leader, but not with such a high margin. You know, if you speak to Sweta, you'll understand that, you know, LVMH is probably 4 or 5 times the market cap of any of its followers now. So there's a bit of a discrepancy in terms of, you know, an ultra leader and then followers that are way far behind today versus where they were 4 or 5 years ago. So Richemont Kering on paper makes sense. Now, the difficulty of that deal happening is probably partly linked to Johann Rupert, who is currently running Richemont, because if you had a merger of Kering Richemont, then you would probably have the question of what his active role would be. Part of the pushback has been culture. You know, I think you have a leader or co-leader of hard luxury on one side with Richemont, with, you know, Cartier and Van Cleef, now competing against LVMH with, you know, Tiffany and Bulgari and other assets. And then you have a leader or co-leader in the soft luxury space with Kering, and the likes of, you know, Gucci and Saint Laurent and Bottega and McQueen, et cetera, and Balenciaga. And some will argue that, you know, in hard luxury, it's a very lengthy process. You're thinking out for the next 3-4 years, whereas in fashion, it's a lot shorter. I don't think it's incompatible. I think the cultures are different, but it works at LVMH, you know, having very sort of long-term approaches with very, you know, fashion forward driven shorter term approaches. So I don't think culture is the issue. I think probably convincing Johann Rupert that it's time to, you know, to be proactive might be the bigger issue.
I see. Well, thank you. That's very clear. Marco, I'm interested as private equity. When do you know it's the right time for you to exit a brand you invested in?
Well, you know, the way we usually invest is we invest beyond the project. You know, we consider ourselves time-based investors, that we are there for a purpose. And what dictates the timing is when we have accomplished what was our vision and our plan. You know, maybe it's easier if I give a couple of examples. You know, when we invested in Moncler, 150 million of revenues, very Italian business, only wholesale. We thought that the brand had the potential to become a global brand and to develop a retail presence. And we embarked in that journey. And when we had not completed, but, you know, established the brand really as a global brand, when, you know, direct to consumer represented, you know, more than 50% of the business, we thought it was the right time. We thought the company was ready to go public. And this is when we decided to go public. You know, similar with other investments we've made, you know, be it Golden Goose, be it Supreme, it always linked to a vision and a journey that we think we can help the company and the management to do. So the timing is dictated by our ability to realize that plan. If you want to take a rule of thumb, you know, if it takes much more than 5 years, it means that something went wrong. If it takes much less than, you know, 3-4 years, it means that you were not ambitious enough. And so, but it's really dictated by the vision that you have, what you set forth as your strategy, and when you were able to achieve what you set out. That's how we approach those investments.
Okay. Stefano, you co-own 6 brands. Do you ever exit brands you invested in?
So at the moment, our priority is to build up the platform, to leverage on the platform to build up individual brands. So we see ourselves as an organism where the brands are leveraging on shared services and tapping into all resources that wouldn't be individually able to tap into. So I cannot deny that we're being asked. So obviously, investing in an early startup is usually, of course, very risky, especially if you don't do this all the time and all your life. But obviously, the returns are pretty fascinating, because when you invest in businesses which are £1 million and all of a sudden they are 15 to 20 million pounds, you're looking at a very exciting opportunity of return. For now, we turned down the couple of tempting offers we had because we want to build scale at tomorrow level. In the future, I'm unable to answer the question, because it depends also on what trajectory the company will go. We are at our own invested by a private equity partner, THCP, who has been very instrumental and supportive in creating the business model. So we will deal with their need to exit and our desires to grow the platform.
I think we were thinking pretty similarly, because when I was saying that scale matters, I was not only referring that, the large brands have an advantage as smaller, but, in your world, you're doing the same thing. I mean, you just said it. I mean, scale matters at that level, and each brand on its own will have more difficulty than they do by being part of that ecosystem that you very successfully created. So I think that the trend and what I was trying to say is that scale matters not really on the brand per se, but having something that allows to share resources, to share investment, to share know-how. And I was just wondering if you agree with that.
Marco, totally. I forgot to mention, I was just about starting my talk by saying scale matters even on the lower, on the smaller side of it. We have 228 employees in the business, and we are growing at a rate of 60 every year, give or take. That allows us to offer enablers from the basic business modeling or finance support, HR, law, legal, etc., to more interesting and exciting, if you may, product design, design development, digital marketing, content creation, etc., etc. Our brands are led by the founders who are visionary and I would say primary figures in their own industry and community, but then they cannot afford, even with our investment, to tap into the number of the talent, level of talent, and number of talents they would need. We are blessed because we have one pillar of our business, which is the B2B, which is growing dramatically. There's a trend in B2B, as we probably know. It's becoming fashionable again all of a sudden, and it's becoming very exciting exactly because the conglomerates are going direct to consumer and leaving a lot of shelf space available to emerging brands. Because we have this fast-growing pillar, we can share the resources on the back of it and create brands. The problem we solve is we lower the break-even. We can launch a brand and assuming a moderate growth, because some of the brands have rightly so the need of being a successful brand as a 12 million euros forever sale. You can break even at 5-6 millions if you tap into a platform. Without, I don't have to explain how complicated that will be.
5-6 million.
It's as little as that. If the ambition of the founder, and we for a number of reasons, philosophical reasons sometimes, decided it's okay to invest in a brand which serves certain purpose, but won't grow more than 12-15 millions in the near future, we can make sure that that business is profitable. But we as a platform, not even individual business, So, sorry, long answer to say yes, Marco.
Thank you. An enduring topic in M&A is why Italy hasn't had, what has kept Italy from having its challenger to LVMH. What's the reason for that? Marco, do you want to start?
I have my own theory, which I don't know if it is shared by others, but I think is linked to what Erwan was saying. If you compare the Italian brands to the French brands, or let's say the LVMH brands, just to take one striking difference is that the Italian brands are still owned by the founders. And I think that until the founders are there, it's going to be very hard for that process to start. You think, the Pradas, the Armanis of the world, I think you need the next generation for that to happen, if it ever happens. So I'm not suggesting it will automatically, but that's kind of, the minimum condition in my view for that to happen. There has been, however, some, initial thought. If you look at what, Renzo Rosso is doing at Diesel, he's starting to, put a couple of brands. Moncler, that was since the beginning very focused single brand, made the acquisition of Stone Island. So, you'll see starting, but for the big gorillas to come into play, I think you'll have to wait the next generation.
Okay. Erwan, Marco mentioned some buyers. What are the key targets in Italy?
Yeah,
And do you think we are at a tipping point?
I don't know if we're at a tipping point. I agree with Marco that in some instances, unfortunately, you're going to have to wait until the next generation decides. But it's interesting how within the most interesting independent companies left, many are Italian. You know, you have a few watch brands, Rolex, Patek, Audemars Piguet. You have obviously Chanel, which is still private, but all the more interesting brands happen to be Italian. And you've seen a bit of a movement. You've seen, you know, Zegna doing a SPAC. You've seen, to Marco's point, Moncler taking over Stone Island, which I interpret as a bit of a test. I mean, we've been publishing on this idea that Moncler had a management team which was almost too qualified just to run one brand. So now they're running two, but the second one is tiny. So hopefully if that test works well, they can look beyond, because I think they have the quality of management and they have the funds to go beyond. And then I was quite intrigued by the Exor approach. So the owners of Ferrari, who have a stake in Stellantis, who, you know, recently took a majority stake in Shangxia, which was, you know, belonged to Hermes for the majority before. They recently took a stake in Christian Louboutin. And I would be very surprised if John Alcan and his team would leave it at that. So I suspect they have broader intentions. But yeah, I think you have families, you have egos, you have the idea that you want to develop your legacy yourself, et cetera, et cetera. I don't know if we're at a tipping point, but, you know, between Zegna, you know, Moncler and Exor over the past 12 months only, there's been a bit of action, you know. Okay. And again, there are very high quality assets that are still independent. And I think it would make sense for some to regroup. Again, there's a difference between what works on paper, as we mentioned with Kering Richemont, and what can actually happen, depending on personalities and you know, family issues and the like.
Sweeta, would you like to add something to Erwan's comments?
Yeah, absolutely. And I also wanted to kind of touch on Erwan's comment. So all the speakers have laid out a very cold, industrial, rational logic for scale and consolidation. But as we know, the luxury industry is often driven not so much by rationality, but by emotion, which is probably why we have seen this lack of scale, particularly among the companies that actually would benefit from it the most. I actually take a different view. I think we're closer to a tipping point than we were, because through the pandemic, we've really seen a hyperpolarization between the winners and the losers. The share of market growth that's accruing to the larger players with scale is unprecedented, and it's continuing. It's not a case that that's now reverting. So if I were a smaller, mid-sized family-owned company, I'd be thinking very carefully about what legacy, if any, I could leave without being part of a bigger group. And I think that thinking has certainly entered. I do exactly. The Zegna SPAC is a sort of an innovative way for a company to gain scale and think about its future much more clearly. And I do believe more companies will adopt a similar route. Possibly, I think there is a notion of trying to want to create an Italian champion. Moncler is leading its way in a very small, through a very small experiment, as Erwan called it, with Stone Island. I do think that their ambitions could be larger than just that, though.
Okay, thank you. And LVMH is branching out to hospitality with the acquisition of Belmont 2 years ago. Kering has invested in Vestiaire Collective. Do you think it makes sense? Why does it make sense for luxury group to think outside of their core competencies, outside of their core categories? Sweeta, would you like to start?
Yeah, absolutely. I think this is going to be very much the future of the luxury industry is really going to be dominated by companies that can think creatively about how they can capture an increasing share of consumers' attention. We're moving into an attention economy, and consumers are choosing to spend their time and attention on a variety and range of different activities and products. And LVMH is really the scale player that has cottoned on to it with its approach across wines and spirits, fashion and leather, watches and jewelry, and perfumes and cosmetics. And this consumer-centric approach is increasingly something that I would expect other companies to adopt as well. I would also say that it makes sense for companies to think about capabilities as well. We're entering a world where in the next 10 years, millennial and Gen Z consumers are going to make up over 2/3 of the total consumer base. Many of these consumers are completely digitally native. We're already seeing the emergence of NFTs and virtual fashion play a bigger role. So I think in terms of capabilities, companies need to think much more, maybe much less about brands per se, than about acquiring competencies and capabilities that can help them win the new generation of consumers.
Erwan, do you agree with Sweta?
Yeah, I mean, I think the leadership position of LVMH probably puts pressure on them as the leader of the industry to redefine what that industry needs to be. And I agree that if you put yourself in the shoes of consumers, the idea is how much more share of wallet can I capture from that premium consumer? And so I think the move to acquire Belmont was quite interesting, even though not incredibly timely ahead of the pandemic, but you don't always choose your timing, right? And as well as purchasing Rimowa, travel. Again, the timing was horrendous, but who knew this was coming? But travel, if you think about Vuitton and the way it started with travel trunks, and I think travel, even though it's Asia essentially is pretty much shut right now, but things will reopen eventually, and I think there's a keen appetite. I mean, there's a lot of pent-up demand to discover the world once it'll be a possibility to do so. So I think it's the role of LVMH to redefine what luxury needs to be, and there is a lot of overlap with health, with sporting goods, with meditation apps. You can think about a lot of adjacencies that have not been leveraged for the time being. I think LVMH can be creative. I think, you were mentioning carrying with Vestiaire. That's yet another, avenue of trying to think about secondhand, which is, a very important development where many luxury companies have been on the back foot, and clearly there is an opportunity to capture or recapture part of the spending there. So yeah, I think this is a time indeed to be creative and to not be stuck. I mean, the biggest acquisition from LVMH recently has been Tiffany. They clearly had a gap there. But to Sweta's point, it shouldn't just be about product. They had a gap in jewelry, they're filling it now, and they have Bulgari and other assets. They might have other product gaps, but I agree, it's not just about product. It's about capabilities. It's about, thinking ahead, not being on the back foot on sustainability, on secondhand. You were mentioning NFT, Sweta. Yeah, I mean, it's interesting that's a big question where it seems that luxury is not on the back foot, because they're probably thinking, oh, we were so late on so many other things, we better get our act together. And I think the great thing about NFTs, it's a slightly different consumer subset. It's more male driven, it's younger, it's probably complementary to the the audience that they're currently selling to. So yeah, I think I think the world of possibilities is much broader than what we think when we just look at luxury on a daily basis.
Thank you. Well, that's all we have time for. Here are my key takeaways from this conversation. Big is beautiful. Consolidation in luxury will continue and be a trend post-COVID. In crisis time, blue chip brands have an edge. Size also helps companies to manage talents, and the French conglomerates have been the champions in having talents that you can shuffle around the group. Seller's market. It's not a buyer's market. Cash is not an issue. There has never been so much cash available, but the real issue is which target is open to sell. Succession, an enduring topic, is a potential emergence of an Italian challenger to LVMH. For years, Italian companies, still largely founder-led businesses, have sidestepped expansion to acquisitions, but recent activity has stirred up the old idea of an Italian luxury conglomerate. Creativity matters. Luxury groups should think wider, outside of their core categories, and in terms of consumers and capabilities rather than brands. LVMH, the world's largest luxury conglomerate, is branching out to hospitality, while Kering looks to resell with a stake, Investia Collective, for example. Thanks to all of our panelists today for being with us. Thanks for sharing your expertise.
Thank you for having us.
Great being here. Thank you for having me.
For everyone watching at home, you can send any follow-up question to ask@voguebusiness.com. And don't forget to head over to our event community where you can meet other attendees and Vogue Business editors, including myself. Enjoy the rest of the Vogue Business and Google Summit. Goodbye.